Something has shifted in the financial markets. If you've been watching silver, you've felt it. The price action over recent months hasn't been typical. It hasn't been quiet, and it certainly hasn't been ignored by the people who understand how these cycles work. This isn't about hype. This isn't about get-rich-quick schemes or overnight fortunes. This is about recognizing a pattern that has repeated itself throughout financial history and understanding what it means for your portfolio, your purchasing power, and your financial future. If you currently hold silver, you're probably wondering whether this move is sustainable, whether you should add to your position, or whether you should take profits and walk away. If you don't hold silver, you're likely asking yourself whether you've already missed the opportunity or whether there's still time to participate in what could be one of the most significant commodity moves of this decade. Today, we're going to walk through the situation calmly and clearly. We're going to examine the forces driving this market, the historical patterns that give us context, and the decisions that disciplined investors make during periods of financial uncertainty. By the end of this conversation, you'll have a clearer understanding of where we are, how we got here, and what thoughtful positioning looks like going forward. Let's begin. For years, silver traded in a range that most analysts considered unremarkable. It moved with industrial demand, responded to dollar strength, and largely stayed off the radar of mainstream financial media. Investors who held it did so quietly, often as a small portion of a diversified portfolio, or as insurance against scenarios they hoped would never materialize. But something fundamental has changed in the broader financial landscape, and that change has begun to wake silver from its long slumber. The first thing you need to understand is that silver doesn't move in isolation. It responds to forces much larger than itself, forces rooted in monetary policy, government debt levels, inflation dynamics, and the collective behavior of institutional investors who manage trillions of dollars. Over the past several years, we've witnessed an unprecedented expansion of central bank balance sheets. Governments around the world have increased spending to levels that would have been unthinkable a generation ago. The money supply has grown rapidly, not just in the United States, but globally, and that expansion has created distortions across every asset class. These aren't political statements. These are observable facts. When central banks create money to purchase government bonds, when fiscal deficits reach record highs, and when real interest rates remain suppressed for extended periods, the consequences show up in asset prices, sometimes immediately, sometimes with a delay. Silver, like gold, has historically served as a barometer for monetary stress. It tends to perform well when investors lose confidence in the stability of fiat currencies, when inflation expectations rise, or when the real return on government bonds turns negative. And right now, all three of those conditions are present in various degrees across the developed world. This isn't speculation. This is pattern recognition. One of the biggest mistakes investors make with silver is treating it like a stock. They look at quarterly earnings, they wait for news catalysts, they try to time entries and exits based on short-term price action. But silver doesn't work that way. Silver is a dual-natured asset. It's both an industrial metal and a monetary metal. That duality creates complexity, but it also creates opportunity for those who understand the interplay between the two. On the industrial side, silver is critical to solar panels, electronics, medical devices, and emerging technologies like electric vehicles. Demand from these sectors has been growing steadily, and supply has struggled to keep pace. Mining output is constrained, recycling provides only a portion of what's needed, and inventories in key exchanges have been declining for years. On the monetary side, silver has been recognized as a store of value for thousands of years. When people lose faith in paper currencies, they don't turn to complex derivatives or exotic financial instruments. They turn to tangible assets with intrinsic value. Gold gets most of the attention, but silver often moves more aggressively because its market is smaller and more volatile. Most people focus on one side of this equation and ignore the other. They think of silver purely as an industrial commodity or purely as a speculative inflation hedge. But the investors who profit from silver understand that it's the convergence of these two dynamics, rising industrial demand meeting growing monetary demand, that creates explosive moves. And that convergence is happening right now. History doesn't repeat itself perfectly, but it does rhyme. And if you study the behavior of precious metals during periods of monetary expansion, currency debasement, and rising inflation, you'll see clear patterns emerge. In the 1970s, when inflation surged and the dollar weakened after the abandonment of the gold standard, silver rose from around $1 per ounce to nearly $50 in 1980. That wasn't a straight line. It was volatile, chaotic, and punctuated by sharp corrections. But the overall move was undeniable. In the early 2000s, after years of low interest rates and aggressive monetary stimulus following the dot-com crash, silver began another sustained rally. From 2008 to 2011, it climbed from under $10 to nearly $50 again. Once more, the path was rocky. There were pullbacks, false breakouts, and moments when it seemed like the rally was over. But patient investors who understood the macro backdrop were rewarded. Now, we're in a similar environment. Central banks have expanded their balance sheets to levels that dwarf anything seen in the 1970s or the 2000s. Government debt as a percentage of GDP has reached peacetime records. Real interest rates, adjusted for inflation, remain deeply negative in many parts of the world. And investors are beginning to wake up to the reality that holding cash or government bonds in this environment is not a safe strategy. It's a guaranteed loss of purchasing power. This is the backdrop that drives precious metals higher, not because of a single news event, not because of a tweet or a headline, but because the structural conditions favor assets that preserve value when currencies are being debased. Silver is responding to those conditions, and if history is any guide, this move is likely in its early stages, not its final chapter. Let's talk about the specific forces at work right now. Understanding these will help you separate signal from noise and make decisions based on fundamentals rather than emotion. First, inflation expectations are rising. Whether you look at consumer prices, producer prices, or asset prices, the trend is clear. Goods are becoming more expensive. Services are becoming more expensive. And the central banks that spent years trying to generate inflation are now struggling to contain it. When inflation rises, investors seek assets that protect purchasing power. Real estate, commodities, and precious metals tend to perform well in these environments. Silver in particular benefits because it's more affordable than gold, making it accessible to a broader range of investors. Second, we're seeing a shift in institutional behavior. Large asset managers, pension funds, and sovereign wealth funds are beginning to allocate capital toward commodities after years of underweight positioning. This isn't retail speculation. This is institutional money, recognizing that the traditional 60-40 portfolio of stocks and bonds may not be adequate in an era of persistent inflation and currency volatility. Third, supply constraints are tightening. Silver mining is a complex, capital-intensive process, and new supply doesn't come online quickly. Meanwhile, demand from solar energy alone is projected to consume a significant percentage of annual production in the coming years. Add in the industrial demand from electronics and electric vehicles, and you have a supply-demand imbalance that's likely to worsen before it improves. Fourth, investor psychology is shifting. For years, silver was ignored, dismissed, or ridiculed by mainstream financial commentators. But as the price rises and the monetary backdrop deteriorates, more people are paying attention. That shift from apathy to interest is a powerful force in any market. These dynamics don't guarantee a specific price target. They don't promise $300 silver by 2026, but they do suggest that the probability of significantly higher prices has increased and that disciplined investors should be paying attention. If you've been holding silver for months or years, you're probably experiencing a mix of emotions right now. Relief that your patience is being rewarded. Uncertainty about whether to hold, add, or take profits. Maybe even some anxiety about whether this move is sustainable or just another false start. Let me offer you some perspective. First, if you bought silver as insurance against monetary instability, nothing has changed. The reasons you bought it are more valid today than they were when you made your initial purchase. Debt levels are higher, inflation is more persistent, and the likelihood of aggressive monetary policy returning to suppress prices is greater than ever. Your insurance is working. Don't cancel your policy at the first sign of danger. Second, if you're sitting on unrealized gains, resist the temptation to sell everything simply because the price has moved. Remember why you own this asset. If your thesis was based on long-term macro trends, those trends are still intact. In fact, they're accelerating. That doesn't mean you can't take some profits. If you're overweight silver relative to your overall portfolio, or if you need liquidity for other purposes, selling a portion of your position is a rational decision. But selling your entire position because you're uncomfortable with volatility is a mistake. Third, consider whether it makes sense to add to your holdings. If the macro backdrop is strengthening, if supply-demand fundamentals are tightening, and if institutional interest is growing, the case for additional exposure may be stronger now than it was when silver was ignored. But add intelligently. Don't chase price. Don't use leverage. Don't bet money you can't afford to lose. Scale in gradually, average into positions, and maintain the discipline that got you here in the first place. The worst thing you can do right now is let emotion dictate your decisions. Stay calm, stay rational. And remember that cycles unfold over months and years, not days and weeks. If you've never owned silver, or if you sold your position years ago and have been watching from the sidelines, you're likely asking yourself whether it's too late to participate. The honest answer is that nobody knows. Markets don't move in straight lines, and there's no way to predict short-term price action with certainty. But if you're thinking about this decision in terms of, am I too late? You're asking the wrong question. The right question is, do the conditions that favor silver still exist? And the answer to that question is yes. Inflation hasn't been solved, debt hasn't been reduced, central banks haven't tightened policy to the point where real interest rates are meaningfully positive, and investor allocation to commodities remains historically low despite recent price gains. If those conditions persist, silver has room to run, not in a straight line, not without volatility. But over the next several years, the probability of higher prices is greater than the probability of a sustained collapse. That said, if you're going to enter this market now, you need to do it thoughtfully. Don't buy everything at once. Don't use margin. Don't invest money you'll need in the next 6 months. And don't expect immediate gratification. Start with a small position, something that won't disrupt your financial life if it declines by 20 or 30% tomorrow. Get comfortable with the volatility, learn how the asset behaves, and if the thesis continues to play out, you can add more over time. Remember, this isn't about catching the bottom or timing the top. It's about positioning yourself intelligently for a macro environment that favors hard assets over paper promises. If you wait for confirmation that the move is safe, you'll pay a much higher price. And if you wait for silver to hit $50, $100, or $200 before you take it seriously, you'll have missed the opportunity to build a meaningful position at today's levels. The time to act is when the fundamentals are strong, but the crowd hasn't fully arrived. That's where we are now. Let's talk about something that doesn't get discussed enough in financial media: probability. Nobody can tell you with certainty that silver will hit $300 by 2026. Anyone who makes that claim is either lying or delusional. Markets are complex adaptive systems influenced by countless variables, many of which are impossible to predict. But probability is different. Probability is about assessing the odds, understanding the range of potential outcomes, and positioning yourself accordingly. Right now, the probability that silver moves significantly higher over the next several years is elevated. Not guaranteed, not certain, but elevated relative to historical norms. That doesn't mean you bet the farm. It means you allocate capital in a way that reflects the opportunity without exposing yourself to catastrophic risk. It means you size your position appropriately, manage your emotions, and remain flexible as conditions evolve. Risk management is the foundation of successful investing. And risk management means accepting that you could be wrong, that markets can remain irrational longer than you can stay solvent, and that the path forward will be anything but smooth. If you own silver, the risk is that inflation moderates, central banks regain credibility, and investors rotate out of commodities and back into traditional assets. That's a real possibility, and it's why you shouldn't have your entire net worth in a single asset class. But the risk of not owning silver, or not owning enough of it, is that inflation accelerates, currency debasement continues, and the purchasing power of your cash and bonds erodes faster than you anticipated. That risk is also real, and in many ways, it's the greater risk given the current trajectory of fiscal and monetary policy. Balancing these risks requires humility, discipline, and a willingness to think in probabilities rather than certainties. As important as it is to discuss what disciplined investors should do, it's equally important to discuss what they should not do. First, do not react emotionally to short-term price swings. Silver is volatile. It always has been. If you're going to panic every time the price drops 5 or 10%, you're not emotionally suited for this asset. Volatility is the price you pay for the potential upside. Accept it or stay away. Second, do not chase headlines. Every day, you'll see articles predicting silver's imminent collapse or its explosive rally to $500. Most of these articles are noise. They're designed to generate clicks, not to provide insight. Focus on the fundamentals, not the headlines. Third, do not use excessive leverage. Leverage amplifies gains, but it also amplifies losses. And in a volatile market like silver, leverage can wipe you out, even if you're ultimately right about the direction. If you can't sleep at night because of your position size, you're overexposed. Fourth, do not blindly follow online influencers or social media hype. There are people out there promoting silver for all the wrong reasons: to sell products, to build a following, or to manipulate sentiment. Do your own research, understand why you're making the decision, and take responsibility for the outcome. Fifth, do not ignore diversification. Silver may be an important part of a well-constructed portfolio, but it should not be the entire portfolio. You need balance. You need exposure to other asset classes. You need cash for liquidity, stocks for growth potential, and bonds for stability, even if their returns are modest. And finally, do not assume this is a one-way trade. Markets move in cycles. There will be pullbacks, corrections, and moments of doubt. If you're not prepared for that reality, you'll make poor decisions at precisely the wrong time. Discipline, patience, and emotional control are what separate successful investors from everyone else. Make sure you're cultivating those traits, not undermining them. Understanding market cycles isn't just about charts and data. It's about understanding human behavior. In the early stages of a bull market, most people are skeptical. They've been burned before, or they've watched from the sidelines as others made money, and they're hesitant to commit capital. This is when the smart money accumulates positions quietly, without fanfare. As the market gains momentum, more people start to pay attention. The skeptics become curious, the curious become interested, and the interested become buyers. This is the phase where prices accelerate, where media coverage increases. and where the narrative shifts from "why would anyone buy this" to "everyone is buying this." In the late stages of a bull market, euphoria takes hold. Everyone is convinced that prices will only go higher. Risk is ignored, fundamentals are dismissed, and new buyers flood in, often at precisely the wrong time. Then comes the inevitable correction. Prices fall, panic spreads, and the same people who bought at the top are now selling at a loss, convinced they made a terrible mistake. This cycle repeats itself endlessly across every asset class. Stocks, real estate, commodities, cryptocurrencies. It doesn't matter. Human psychology drives the same pattern over and over again. If you're going to invest in silver or any other volatile asset, you need to recognize where we are in the cycle and position yourself accordingly. Right now, we're likely somewhere between the early and middle stages of a move. The skeptics are still vocal. Mainstream media coverage is limited, and most investors remain underexposed. That's not a guarantee of further upside. But it does suggest that we're not yet in the euphoric late stage where risk is highest. Stay aware, stay disciplined, and don't let the crowd dictate your decisions. To truly understand what's happening with silver, you need to zoom out and look at the bigger picture. We're living through a period of extraordinary fiscal and monetary experimentation. Governments are running deficits that, in many cases, exceed 10% of GDP. Central banks have expanded their balance sheets to levels that would have been considered reckless a generation ago, and the consequences of these policies are beginning to manifest in ways that affect every investor. Inflation, once dismissed as transitory, has proven to be more persistent than policymakers anticipated. Supply chains remain fragmented, labor markets are tight, and the cost of essential goods, food, energy, housing, continues to rise faster than wages for many people. At the same time, interest rates have risen from historic lows, but they remain below the rate of inflation in many cases. That means real interest rates, the return you earn after accounting for inflation, are negative. Holding cash or government bonds in this environment is a guaranteed loss of purchasing power. This is the environment that drives investors toward alternative assets. Real estate, commodities, precious metals, and even cryptocurrencies have all benefited from this dynamic. People are looking for ways to preserve wealth, not just generate returns. Silver fits squarely into this narrative. It's tangible, it's scarce, it has industrial utility, and it has a long history as a store of value during periods of monetary instability. The question isn't whether these trends will continue indefinitely. They won't. At some point, fiscal discipline will return, inflation will moderate, and central banks will regain credibility. But that day is not today. And until it arrives, the conditions that favor silver remain intact. One of the biggest advantages you can give yourself as an investor is the ability to think long-term. Most people are focused on what happens next week, next month, or next quarter. They react to every headline, every price swing, and every change in sentiment. And as a result, they buy high, sell low, and never capture the full potential of the assets they own. Successful investors think differently. They focus on years, not days. They build positions gradually, hold through volatility, and let compounding work in their favor. They understand that the path to wealth is rarely a straight line, and that patience is often more valuable than intelligence. If you're investing in silver, you need to adopt this mindset. Don't obsess over daily price movements. Don't check your portfolio balance compulsively. And don't let short-term noise distract you from the long-term thesis. Ask yourself, do I believe that inflation will remain elevated over the next several years? Do I believe that central banks will struggle to normalize policy without causing economic pain? Do I believe that supply-demand fundamentals for silver are tightening? If the answer to those questions is yes, then holding silver makes sense. Not as a trade, not as speculation, but as a strategic allocation designed to protect and grow wealth over time. And if the answer is no, or if you're uncertain, then you need to either do more research or accept that this asset isn't right for you. There's no shame in that. Not every investment is suitable for every investor. But don't make the mistake of bailing out simply because you're uncomfortable with volatility or because the crowd has turned pessimistic. Those are the moments that separate disciplined investors from everyone else. We've covered a lot of ground today. We've talked about what has changed in the financial markets, why silver is responding the way it is, and how thoughtful investors position themselves during periods of uncertainty. We've discussed the importance of understanding macroeconomic forces, recognizing market cycles, and managing risk intelligently. We've explored what this moment means for those who already hold silver and those who don't. And we've addressed the common mistakes that undermine investment success. If there's one message I want you to take away from this conversation, it's this. Understanding cycles and preparation matter more than reacting to noise. The financial world is noisy. Every day, you'll be bombarded with opinions, predictions, and headlines designed to provoke an emotional response. Your job as an investor is to filter that noise, focus on what matters, and make decisions based on reason rather than fear or greed. Silver may not hit $300 by 2026. It may not even hit $100. Or it may exceed both of those levels and surprise everyone. Nobody knows. But what we do know is that the conditions driving this market, inflation, debt expansion, currency pressure, and supply-demand imbalances, are real. They're measurable. And they're unlikely to disappear overnight. If you choose to participate in this market, do so thoughtfully. Size your positions appropriately. Stay disciplined. And remember that the goal isn't to get rich quickly. It's to preserve and grow wealth over time in a way that allows you to sleep at night. Stay informed. Stay rational. And most importantly, stay focused on the long-term fundamentals that drive real wealth creation. Thank you for your time. I'll see you in the next one.